At some point in your life, someone told you money is printed. Fresh bills rolling off machines, ink, paper, serial numbers. That story feels solid, physical, reassuring. It's also mostly wrong, because most of the money you use every day was never printed. Not on paper, not on a screen, not even approved in the way you think. It was created quietly, with a few keystrokes, by institutions you rarely think about, while you were asleep, working, or scrolling. And once you see how it actually works, it's hard to unsee. Because this system doesn't just create money, it reshapes power, risk, and who wins when things go wrong. Right now, this matters more than ever. Inflation feels sticky. Debt keeps climbing. Central banks swear they're in control, and yet money keeps appearing. So let's slow this down, strip away the jargon, and walk through how money really gets created without printing anything at all. Start with something familiar. You walk into a bank. You apply for a loan, a mortgage, a car loan, a business loan. The bank looks at your income, your credit score, your history. Then they say yes. Here's the part most people imagine next. The bank takes money from someone else's savings, maybe from deposits sitting quietly in accounts, and hands it to you. That feels logical. It's also not what happens. When the bank approves your loan, it doesn't move existing money. It creates new money out of thin air. Your loan amount appears in your account as a deposit. At the exact same moment, the loan appears on the bank's balance sheet as an asset. No vault opens, no pile of cash shrinks, no saver loses a dollar. New money simply comes into existence, not printed, typed. This sounds dramatic, but it's not a loophole. It's the core design. Banks are not just intermediaries, they are money creators, and they do this every day. To see why this works, forget the word money for a second. Think in terms of promises. Modern money is a promise system. When you deposit money in a bank, you're not storing cash. You're holding a promise from the bank to pay you. When the bank gives a loan, it creates a new promise, your promise to repay, and balances it with its own promise to let you spend. As long as people trust those promises, the system works. Trust is the raw material. This is why bank runs are terrifying. If too many people stop believing in the promise at once, the illusion breaks. But under normal conditions, the system hums along quietly. Here's where it gets uncomfortable. If banks can create money whenever they lend, what stops them from creating infinite money? Two things, and neither is as strong as it sounds. The first is regulation. Banks are required to hold a certain amount of capital, their own money, relative to the loans they issue. This is supposed to act like a speed limit. But speed limits don't stop cars, they just shape behavior. In good times, rules are loosened. Models look safe, risk feels distant. The second limit is demand. Banks can only create money if someone is willing to borrow. This is where the economy and psychology collide. When people feel confident, borrowing explodes. When fear creeps in, borrowing collapses. Money creation rises and falls not with printing presses, but with mood. This is why booms feel euphoric. New loans create new money. New money fuels spending. Rising prices feel like growth, until it doesn't. Now zoom out. If banks create most of the money, what does the central bank actually do? This is where the myth really cracks. Central banks don't directly control how much money exists. They influence it indirectly. They set interest rates, they signal confidence or caution, they nudge behavior. Think of the central bank less like a commander, more like a traffic cop in a storm. It can flash lights, blow whistles, redirect flow, but it doesn't control where every car goes. When a central bank lowers interest rates, it's making borrowing cheaper. That encourages banks to lend, which creates more money. When rates rise, borrowing slows. money creation slows. Notice what's missing: printing. Printing physical cash is a tiny footnote. Cash is only a small fraction of the money supply. Most money exists as numbers in bank ledgers, promises layered on promises. This is why phrases like money printing are misleading. During crises, central banks don't usually print money. They swap assets. They buy government bonds from banks. They credit bank reserves in return. Reserves are not money you spend at the grocery store. They're money banks use to settle with each other. It's plumbing, important plumbing, but plumbing nonetheless. The real explosion happens when banks turn those conditions into loans. This is where hype and reality diverge. People imagine central banks flooding the economy with cash. In reality, central banks create the conditions and private banks do the creation, which means money creation is decentralized, competitive, profit-driven. That should make you pause, because profit-driven systems don't optimize for stability, they optimize for growth. This is why money creation is pro-cyclical. It accelerates booms and deepens busts. When times are good, banks lend aggressively. Money multiplies. Assets inflate. When times are bad, banks pull back. Loans shrink. Money disappears. Yes, disappears. When loans are repaid, money is destroyed. The deposit vanishes. The promise dissolves. This is the part almost no one talks about. Money is born with debt, and it dies with repayment. This creates a quiet paradox. The system needs constant borrowing just to stay stable, not to grow, to survive. So if borrowing slows too much, money supply contracts, spending falls, businesses struggle, unemployment rises. So policymakers walk a tightrope. Too much borrowing creates bubbles. Too little creates recessions. Now layer in government debt. When governments run deficits, they issue bonds. Banks buy them. Central banks often step in later. This injects more promises into the system. Debt stacks on debt. And because the system is built on trust, it works, until confidence wobbles. This is why crises feel sudden. The system doesn't slowly break. promises typed into ledgers. What happens when people stop believing the numbers mean what they used to?